Yeah, hi, ladies and gentlemen. I'm Srivathsan. I'll be the moderator for today's session. The session would be about concentrated equity investing and Indian experience. Few housekeeping points before we go down into the details and into the webinar. Today's webinar is scheduled for 60 minutes, including question and answer session. We'll be leaving time for question and answers after the presentation. Please feel free to submit your questions throughout the presentation. You can do so by clicking on Q&A link at the bottom of your view and typing your questions in the box. The webinar presentation will be available post the presentation concludes. We value your feedback, so please complete the evaluation survey before you sign off for the day. Now, I will go ahead and introduce the speaker of the day. While there's a formal introduction, I still remember the first time I met with Hari. That's how most of us know him. Possibly 2007, January or February was the first time I met with Hari in our office in Chennai, and we've had known him for almost last 14, 15 plus years. And then it's been a great relationship, both for me personally and for the firm I work for. To more talk about the professional background of Hari, has about 21 years of experience in the equity investments spanning across private and public. In his private stint, he was with Ascent Capital, which was erstwhile UTA Ventures, and Lazard and Lavigo Partners during his private stint. In 2015, he started Blue Lotus Capital along with a couple of his partners and his founder and managing partner. At Blue Lotus, they manage about $250 million of assets under management with a combination of Indian equities and also some offshore equity strategies on the arbitrage front. To give a quick background on his education, he's a Bachelor's of Engineering and an MBA from Trichy. Hari, over to you.
Hi, thanks, Srivathsan, for the introduction. Good evening, friends. It's a pleasure to be here, and thanks CFA Society India for giving me this opportunity. For most things in the life, if something makes sense, then the opposite could also equally be true. This is quite true about several notions of investing, including the debate on concentration versus diversification. The idea here is to make this very dogmatic, not to make this very dogmatic, as we are talking about a fuzzy marketplace where most of things are gray. There is always a dilemma. In this presentation, I will try to explain how we gone about addressing this dilemma. I put the heading as an investor's dilemma. Okay, the standard disclaimers. We are not recommending any methods. All investors need to assess their own risk profiles while constructing their portfolios. Okay. What is the ultimate purpose of investing? It is to generate and protect the wealth over a long period of time. And it varies between various investors depending on one's own context. There's an eternal dilemma on how to go about it. There are two styles of portfolio construct. One is a concentrated portfolio, another is a diversified portfolio. The concentrated portfolio, what we talk about is a few stocks, few sectors, looking for the multi-bagger returns, and which also associated along with this a risk. And opposite side, we have a diversified portfolio, which has been, when we say diversified portfolio, the portfolio needs to be diversified in such a way that all the assets should not correlate with each other. That's the true diversification. And holding and a variety of non-correlated assets can nearly eliminate an unsystematic risk. That's all about the diversified portfolio. And this diversified portfolio also depends upon the two theories which we all know about it, the modern portfolio theories, which says that the more you diversify the portfolio, the less the risk. And the efficient market theory says that the active money managers have no stock picking process. It says that the market is efficient, so every information is already priced in, and that's this the basic concept of this concentrated on the diversified portfolio. The one biggest negative thing on the diversified portfolio is that 60 to 80 stocks portfolio. Someone needs to monitor that, and also most of the time the returns are tends towards the benchmark returns. Both these approaches are been backed by legends, and both the sides have been vocal about their investments strategies. People like Warren Buffett and Dr. Miller, who are concentrated investors portfolios, and also we have been the other side. We have Templeton and Benjamin Graham, who have advocated the diversification. Even Warren Buffett says that diversification may preserve wealth, but concentration builds the wealth. On the other hand, the founder of Vanguard, Jack Bogle, says, don't look for the needle in the haystack, just buy the haystack, right? So both the side of the spectrum, there is a strong arguments. So how do we choose? Okay, does the first and foremost question, does a diversity really reduces risk? We have two studies have been done between the two time frames. So one in 1977, another is 2016, and both the studies eventually came back with the same end result, is that after 15, beyond 15 stocks, the incremental risk reduction is negligible. This has been proven by 1977 research paper done by Edwin Elton and Martin Gerber, which has been published in the Journal of Business, University of Chicago, which has very clearly proven that any stocks above 15, the incremental risk is reduction in the incremental risk is negligible. And the same thing has been proven by the KRA research study as well. So how do we resolve this dilemma? So by understanding the investing intelligence is more than IQ. So what we call this as a IQ in our framework. This is intelligence, intensity, and the involvement. This is a three basic things which we look in order to generate a superior returns. Okay, so first let's understand the whole IQ spectrum. The one end of the spectrum is we have an entrepreneurs, and another other side of the spectrum is your casual investors. The entrepreneur who has the highest intelligence, business intelligence, has a very high intensity, and his involvement is very high because he runs the company. And then the other side of the thing, the casual investor, he may have a low business intelligence and low intensity and non-existent involvement. If you look, the entrepreneurs, the maximum wealth has been created from a core single business. That's the level of concentration which they have been taken on this thing. If you look, Steve Jobs from the Apple, or Reliance Industries for Mukesh Ambani, or Facebook for Zuckerberg, or Infosys for Mr. Narayana Murthy. So they are involved in the one single business, and their biggest wealth has been created from that single stock. That's the one level of highly concentrated investing. Then we have the right hand side, the casual investors who just participate in the journey of this highly successful entrepreneurs. In their journey, they participate in their company through highly diversified mutual funds or the ETFs. That's where they create their wealth. So you know the entrepreneurs makes the biggest the wealth created compared to the casual investors. So if you want to be a professional investor to increase your portfolio return, we need to move towards the left. So what happens when you move towards the left hand side of this IQ spectrum? The first and foremost, you become the style agnostic. You start marrying the growth and the value investing philosophy. So you will start looking for the value in the every growth stock, and similarly you look for the growth in the every value stock. So you no more constrained to whether it's a value or a growth stock. The second most important thing is that you start filtering the signals from the market noise. And the third is that you will become much more focused and a deep understanding of a few sectors. These three things starts evolving when you start doing when you start moving from the right hand side to the left hand side of the spectrum. Okay, how can we build the IQ? So the first thing in this IQ spectrum is the intelligence. And this is to, first and foremost, is to understand the industry and the company business within that industry. Understand how the unit economics works in the business. And focus on the product and services what this company is offering and how long it's offering. So this is the basic fundamental building block for developing your intelligence. And most of these informations are readily available in the marketplaces. The second is the intensity. This is the most important thing within the IQ spectrum. As the time and the effort the investor puts in to understand the second level information about the business, the promoters, the type of clients, the vendors, the channel partners, etc., will gives you to understand much more information about what the information you initially you collected in the intelligence stage will be able to scrutinize more in this intensity stage. You start doing a due diligence on all the information which you collected from this thing, and then you start doing a close analysis of all the regulatory filings, annual reports, and the past con call details to understand the overall business of this company. Actually, this informations are today in this information age. These informations are available for everybody at the same time at the same place. There's no information arbitrage between an institutional investor or a retail investor nowadays, because today the same news has been flashed or the same data points are available for all kinds of investors. Basically, the hedge comes here from the interpretation of these data and arriving at the second level of impacts. This is becoming the more crucial in this intensity phase. Otherwise, the primary data is available for everybody. The investor needs to understand what is the second level of impacts based on this data or the information. That gives the hedge. Then the third is the involvement. This has happened is that a post-investment in the company, you start participating in the AGMs and the con calls of the company, and start directly interacting with the management in the events and seminars, industrial seminars, and other public forums. And once you understand about this company, you also start tracking the competitors, their market position, their actions, how that will impact the your own companies, the companies which you are invested in this, and also the regulatory frameworks which keep changing on the regular basis. See, this needs much more involvement from the investors side. This is where you will be moving from the right hand side of the spectrum towards the left hand side. Journey starts. So, okay, when you know that you're already moving towards the left, you start developing edge on some opportunities. As I was saying that this is becoming you can't have too many sectors to look for. So you will start narrowing yourself to the couple of sectors, and you will be start doing going deeper and deeper in that sector, and then you start developing hedge. You will able to find the nuances of each businesses. Once you get this edge, then you start realizing that you have having a better assessment of odds to whether this bets can able to be a positive or a negative return it can give you. So the bets, it's obviously most of the CFA candidates knows that this bets are all is the probability of making the percentage of your risk reward ratios. When the each hedge and the odds leads to optimizing sizing of your bets in the portfolio. You all know Kelly's criteria, which gives you the sizing of the portfolio. But you should also size up the maximum in your for the idea which has the maximum. You have the highest hedge and the highest odds will be have the maximum allocation in your portfolio. Even though the Kelly's criteria gives you an outer bound, the upper bound for the allocation, your allocation also depends upon the your fund limits. There are some funds which has their own limits on the individual investment in the stocks as well as the sectoral exposure limits. And also from an individual investor's perspective, it also needs to be looked into the risk-taking capability of the investors. The Kelly's formula can give you a 30-40% exposure, but as an investor, you also knows that that's a too extreme an allocation for your portfolio's perspective. So it's once again you will end up with a bit of your own judgments. That judgments comes from the spectrum what we've spoken about. The IQ intelligence, what you build it upon that. The optimal sizing actually amplifies your return when it goes right. Okay, before it goes to our experience, our experience in the IQ, I also want to discuss one most important thing is that the choosing of the bet size, whether it is a concentration or the diversification strategy which you do, that depends upon an individual investors. The individual investors, not only it's institutional investors, as I said, the fund has its own limits on the stock exposure or the sectoral exposure. Even an individual investor, a casual investor, or a common investor needs to has one's self-assessment on their own capabilities. The first and foremost is they need to see that do have the edge to assess the odds for betting in that stock or the company. Is the investor has the psychological appetite to see a divergent performance over the benchmark in a shorter term frame or some medium term frame till your bets start giving you a return. And also need to assess whether we have an appetite to see that the volatility in the portfolio or the individual stock. And the last and final thing is that is the overall investment in motivation of whether this investment is what we are doing is for whether it's for the preservation of the capital or the wealth generation. This is the self-assessment which before someone goes into a concentrated or the diversification portfolio strategy, because these assessments is based on the one individual investor's their own context. Nothing. It is just to take away from the other the peer competitors or the other investors whom they got an idea or they got the what is a scuttlebug, right? This is needs to go one investor needs to assess their own risk matrix in creating the concentrated portfolio, because the concentrated portfolio needs the kind of an intensity and the involvement which we've spoken about in the I3. Then only an investor can step up towards that concentrated investment strategy. And that's a journey. It can't happen overnight. That's what, as I said, it's a diversification. The concentrated investment does not mean that it's a number of stocks. It's a non-correlated stocks which needs to be, as in the case of diversified strategy, where we need a non-correlated stocks to take care of the diversification. Same thing in a concentrated portfolio. We also need to have a portfolio or the sectors which can has the same kind of risk matrix. So this is a general thing which I want to talk about the I3 spectrum and the when you move towards the left hand side of the spectrum, how you will able to start building the concentrated book. And I can give you our own experience of doing this, using this IQ framework. This is our concentrated portfolio 2015 vintage fund, where we outperformed the benchmark by 6.8x time, and the absolute gross return of around 320% compared to the our benchmark 38.8%. This came over the period of 3 years time. Okay. What worked for us? We gone about this portfolio. When we created this portfolio, we started building up the portfolio. The maximum we went is the 15 stock portfolio. At the maximum, when we were holding it, it was a 15 stock portfolio. It varied from between 13 to 15 stock portfolio, depending upon how you churn the portfolio. And we focused only on 5 sectors. And these 5 sectors has a very strong high benchmark returns. When we say the high benchmark returns, their ROCs are pretty high compared to the other sectors. We invested, the minimum is 5%. One of the allocation is gone into the minimum is a 5%, and the maximum allocation is gone to one of the stock at 18% allocation. And just to give you the thing, since we all come from the private equity background, where we do the due diligence and we also run the businesses. So for us, doing the investing, focusing on more on the business than the valuation or the stock price, which normally used to be in the secondary market. So, and coming from the private equity background and backed by our decades of our experience in these sectors, which we've been focused and worked for so long, and we are able to understand the business economics, business metrics very well, and we're also able to take slightly longer calls and able to understand the second level impact of some of these businesses which the promoters start building it. So that's work for us. The key to resolve this dilemma, whether it's concentrated or diversified, is to transcend it by developing our own IQ, and also one to evaluate their own risk matrix to their own context. That's the most important thing. The self assessment of an individual investor is more important before even you are entering into whether to be a concentrated or a diversified portfolio. And thank you. I just finished my thing, and Shri, I'm open for Q&A.
Thanks, Hari, for that insightful presentation. I think so. While there are some questions that are popping up in the Q&A window, I thought I'll start off with a couple of more broad-based questions. You said pretty easily that you had an 18% allocation to a particular stock. How do you build a conviction for something of that nature? It will be helpful for many people here for you to get a sense as to how this is built. It's not an overnight process. You did talk about the iCube process, but take an example if you can name a specific stock which you may hold in your portfolio now or do not hold in your portfolio, but if you can take us through how the conviction is built, how at various stages, maybe you did a top up, you didn't do a top up, just walk us through with the help of an example if possible.
As I will not talk about the individual stock, but I will talk about the company which we started doing that and how we started building our conviction level. So this company which when we started building this, met this company is in the pharmaceutical space and one of the API players. And when we start looking this company and when we start understanding this whole API sector, and within that API sector, who are the players which has the competitive advantage, where it's not that that molecules which they are manufacturing, how many people are manufacturing on this thing. Once we met the managements and once we started doing analysis on the competitors or who are the other competitors in India, and this the particular company start building their own process, which is much more proprietary in nature, and the cost of making the same API compared to the competitors is less than a 60-70%. So that is the one thing which this information obviously came from when we are meeting with the industry people, and when we met their own customers, and I think every time they say that this is the company which the cost is so their cost control is so much where you can able to source it the material at the cheapest price for the formulation gas, right? So we started building this position. I think we started with around 6-7% kind of a position. Then I think we waited for 2-3 quarters still to see there are a couple of products launched which they're supposed to bring in. So that all happened, and once that start building anything, we started building the positions. So we started building the position at a higher prices, but because your conviction levels start increasing, that's where you start feeling that you have that little edge. What you analyzed on that the cost competitiveness of this firm is start to coming in the margins. Once you start seeing that coming in the margins, your ROE start expanding, right? That's where you start building up your position. Eventually, we ended up with at one point of time, we went into around, that's why I said we went into all the way to 18%, on the portfolio. But also in order to apply the risk matrix as well, we also need to start, even though company is doing good, even that company is, even still we are shareholders holding the stock in our other fund from this first fund. But we also start liquidating the position also, even though the company is doing the ROE is still increasing, and the PE multiple also is expanding. So that's where we gone about it. But it is as I was saying, that since we've been there in the private equity side, understand that pharmaceutical place for the 15 years where we were doing the pharma and IT investment, technology investment. So we are able to see the company and we are able to build the position much higher. And even after knowing the company, knowing the technology and other things, we also started slowly building. It's not that the day one we have that 15% or 18% portfolio. we built that over the 3 quarters.
Sure. Thanks. Actually, as a part of it, actually, one of the participants has sent a question. Uh, is exactly around how do you manage breaches on risk because of portfolio allocation, and is there any specific thought process you have towards computing risk-adjusted return for a concentrated portfolio?
Yeah. So see, when we went into a concentrated portfolio, calculating your Sharpe ratios or the risk-adjusted ratios and all this, it's meaningless, because at the end of the day one, you know that you are doing a concentrated books, and that is what exactly I said. When you are assessing your own assessment, you need to see whether you have the psychological appetite to see through that there is a divergent underperformance happening from your benchmark return. Whether you are you having to see the appetite to see that volatility in that stock price, because this is the conviction level. What when we say about a conviction level, that's the hedge which you got it. There is some information or something hedge which you see that, like as I said on this pharma company, we felt that this company is having this cost advantage and having the new product pipeline which will start coming up. So when the economic scale kicks in and the new products comes in, then automatically your ROE is in. Yes, you need to go through that pain. So whether you look for that say Sharpe ratios or a risk-adjusted return and all these things will become a meaningless, because we are not diversifying. The day when you're going into that concentrated book, you are going to associate it with the volatility. You are going to associate with the your underperformance for some time. So that's where this will happen.
Sure. Well, you did mention that you chose certain specific sectors to invest in. It will be helpful if you can, was it based on what kind of filters were used, both to filter sectors and maybe stocks within those sectors for an initial screening process?
Yeah, we as I said, we start with a high benchmark on the industry, that industry's return, right? We are looking for an industry which by nature generates an ROC of in excess of 15-16%. So that means then you are then taking away a huge sector out of your screening itself. So when we start with this high level of ROC businesses and ROE businesses, in our case, we have been coming pharmaceuticals. Then we have technology. Third is the consumer businesses, and the fourth is the services businesses. Which there are some monopolistic services businesses which we have been betted on this thing. So it's coming back when we start with it, the screener start with that your ROCE and ROE, and and the second thing is that we don't go into the highly leveraged companies. So these two things will ensure that you are not, not investing in some commodity play, or not investing in some industry which has a highly leveraged industry. So you are taking away so in one way, in the concentrated portfolio, you are taken away some of this volatility out of your way, because these are the industries which has the nature of volatility or the cyclical in nature. You're just taking away out of this thing and focusing on the industry which is a kind of an in a one sense, it's a kind of an evergreen compounders.
Couple of questions from various participants around one. How do you manage drawdowns? There are extended period of times when markets do not perform well. So how do you manage such heavy fluctuation, and how do you use cash as an optionality? Is that a meaningful role does it play, or do you even explore shorts?
No, we don't do shorts. That's first thing, which we are completely long only fund. We take a very aggressive cash calls. That's the one thing which the flexibility which we are having. That we are at a stage. Some I think we in the current fund at one stage we were at a 60-65% cash level as well. When we don't have an ideas and other things, that's a thing which we need to go through it, and that's also comes back once again saying that the the quality of the your money which you have been managing. In our case, it's a close-ended fund, so we are not worried on our month-on-month performance or quarter-on-quarter performance. That is very tough in an concentrated book to looking into to beat the benchmark on a monthly basis or on a quarterly basis. So we will take a very aggressive cash calls if we see there's no ideas are not there. So we will continue to hold the cash levels. And similarly, if we feel that some of the ideas have been overvalued or achieved the things which we have been estimating, that then we will also start booking the profits in that. So we may bring down our holdings from say 18%, we may bring it down to a 9% or 10%. So that's a one way of managing your risk on this.
Sure, Hari, that's helpful. Actually, one of the questions that's come in is along the same lines. What drives your exit? Is it deterioration of fundamentals, or is it just that you feel it's too heated up, the entire sector, the broader markets? What drives your exit strategy?
Yes, yeah, it's a mix of both the market as well as the on the industry level and the company level as well. So it's a mix of things. There's no fixed formula that we go on this thing. The first and foremost is always the earnings. When what we see is that whether the earnings is already been the growth trajectory is already been achieved, whether the company is already achieved the peak ROE, whether the margin expansion is already been started, started decreasing. So we will see that whether our contribution of alpha to our portfolio also. That's another thing. Individual stocks that contribution to our alpha into the portfolio also we need to see. Once we start that alpha started decaying, the first thing is that you need to start cutting that portfolio, because that will not show you at the overall stock price level. You can't able to find it, but when at a portfolio level, when you're looking the individual stocks and their contribution to your alpha, then you start seeing that stock which has been already run up and that stock alpha started decaying, where it is started contributing say 15-20% of your alpha, it started decaying, right? Then that's a time where you take the call, and the thing is that to move to another idea.
A quick address to the participants. Please fill in the feedback form that would have popped up in your screen. These feedbacks helps us to fine tune events like this even better. Thank you. So Hari, going on, a couple of questions around the fact that you are choosing certain specific sectors. Does it mean that in volatile times, like something that happened in March of 2020 or something which nobody was prepared of, how do you manage such events when you're running a few sector or a few stock portfolio, especially?
Sri, actually, you also seen that we are also seeing our portfolio falling during the March fall. But we also seen that our portfolio also recovered much faster than the overall market as well. The biggest thing is that this all cash generating businesses where we have invested in them. So and during this COVID time, especially if you have the three biggest segment which also benefited as the pharma, technology, and the consumer businesses. So which is also is come back for us in the during this time frame. As I was saying, we are not playing the macro themes as such. So when you are playing a macro theme, then you have to worry about the interest rate scenarios, the inflations, and all these things. Because we don't invest in, say, banks and the financials. We are completely stayed away from, which is the much bigger market on this thing. So we are not in the oil and gas. We are not in the infrastructure space. We are not in the real estate space. So what is happening is that when you are able to take out all this sector out of this thing, when you are focusing on a sector which are much more, as I said, an evergreen and the compounders kind of things, your portfolio will come back to the earnings will come back. So maybe the stock price may take a time to come back to catch up, but the earnings will come back faster. That's the most important for us to looking when we look investing in this companies and the sectors.
Sure. One interesting question that's come Yes, a lot of the companies that you have talked about in your portfolio tend to reflect what broadly you can classify as high quality companies. It also tends to suffer a higher PE at some, even at the entry point. How do
Yes.
you manage from a margin of safety, especially when it comes to valuations, when you're buying maybe a stock at 25, 30 times PE and then holding it up forward?
Yes. So that's another dilemma which we all keep, sir, right? Someone's cheap is other person's costly, right? That's where the market operates. And so, yeah, we it's all depends upon where we entered the market, at what price we entered that stock. And as I was saying, that if you start calculating your alpha decay happening in your portfolio, then you know that market is more or less pricing the high whatever the earnings expected from that company. So then we will start looking for the exiting, whether the 70 P is costly or whether it is a 90 P is costly. Which also another thing will be also, once again I go back to my favorite thing, is it's also another thing is a context to the market as well. It's not an individually, we can't take a call saying that sometimes in the market at a 60p we must have been sold out, but even at some in another context of the market where an 80p also we still holding on, right? Because that's also depending upon the overall the earnings yields of the markets and the what happening now in the thing, the flow of the money which is coming in. So in this kind of a situation, the weightage which we do to the valuation may not be high.
Sure, sure. While you did talk about a position in which, or a situation in which you had the advantage of what we call average up, as the performance becomes better, you have more conviction. Take us through if there are any examples where it's been gut wrenching, 30%, 40%, 50% drop down from the time you entered. Did you end up cutting up the stock, exiting the portfolio, or actually ended up doubling up and you retained a conviction and came out of it with much, much better returns?
Yes, yes, we had drawdowns, and one of the companies has to go through a bit of US FDA issues, and the stock has been fallen, and so, but when it is falling, we are not averaged out. The first and foremost, what we've done is that we waited for the issue, why the stock has fell. The fell is due to the US FDA warning. It came and the stock started falling in, right? So we were waiting for the company to address that issue first and foremost. So we are not start buying the stock when it start falling, whether it is a 15% or 20%. And I think we at one point of time it is actually a 40% down from the price which we ever bought it. But when once we started looking the management commentary and they're working on to sorting that problem, I think within the 2 quarters they are able to come back and able to give the to the regulators, the filing the US FDA. They started filing this thing. Before that, there was an UK regulator who already came and approved that facility. So we were very confident that since already another regulator has also this will look at, who was also as stringent as your US regulator. So we felt that the company is in the right path. So that's the time where we start buying in. So we are not start buying in when it fall at 20% or when it, because we don't know where it will go and end up, right? So but we are very clear on this thing. This is the issue which can easily will be addressed by the company. And we also spoken to the experts in that time. We have been spoken to some of the pharma experts and even including some of the regulators in that space, and understanding that how serious is this thing, whether the company able to achieve this thing. So we have been seeing a 40% cut on our thing, but we started adding that, we start averaging out once we got a signal coming from another regulator who started approved this thing. So we felt that that is now this company started in this thing. So it's a matter of another quarter or two where even the US FDA will come and approve this thing. I think that's what happened. So you need to go through the pain process of that 4-5 quarters, the underperformance in that individual stocks. But at a portfolio level, it may not be that much of drawdown, but at an individual stock, yes, it is happening.
Hari, a lot of participants here either are managing their own portfolio or are aspiring to be professional fund managers. With your decadal experience, just take us through how important it is to align interests. That is, the investors in your fund and your investment philosophy, the necessity to align that if you're a professional fund manager or you're a personal money manager, the importance of aligning your investment goal to your portfolio. Just take us through, because we've seen many examples where people pick great stocks, but investors are not aligned, and you see that causing a lot of chaos to portfolio.
Yeah. So, Shri, that's what I once again coming back to my same thing. We can't have one set of a portfolio which can be fit to every investors, because there is no investor is same, and that's where the market is all about, and that's where someone is selling and someone we are all buying it, right? So it has to be customized to each individual's risk taking abilities. And as we were saying, there are two things: whether you want to preserve your capital, that's what your main objective of your portfolio, or you want to create a wealth. And if you want to create a wealth, then look for the thing is that what is the kind of a return you are expecting, and what is the time frame. See, the return on the time frame is more important when you are creating the portfolio. Since I said that we had an advantage of a 5-year fund, where I also don't need to look my monthly performance or a quarterly performance, because we are able to take that longer calls, and we are able to create that concentrated portfolio. If an investor is not willing to lock the money for say 5 to 10 years kind of a thing, then it is better to be in a much more diversified portfolios, or towards the ETFs kind of a thing, which will be able to give you the market return, and which also will give you the liquidity which you may need it whenever you need it, right? So this creating a portfolio and a model portfolio and fitting to every investors, it will not work, because you may be looking for an investor who are a millennial who just joined the workforce and start creating a wealth, where his risk-taking ability is much higher than say a mid-aged group, a mid-aged person who's 50, 55 years old, right? So yes, we will all talk about that asset allocation, 60 debt and 40 equity and other things, right? Even within the equity also, we need to see that it's not that 60% has been debt has been invested, that means 40% equity I can go aggressive. No, that may not work, because that's where this problem comes in. Because at one side of your portfolio, in your personal portfolio, you have taken a debt which is not an volatile, which is going to give you an consistent return, where the upside is capped. Whereas in the remaining 40%, you can't try and increase your risk profile, saying that the 60% needs to be compensated in the remaining 40%, right? Even that 40% also will have the same kind of a tendency of what you have done in the 60. It can't be, you can't add a more high beta, because you may having a portfolio, a debt portfolio, which is giving a 6.5%, and you're creating which a very high concentrated equity portfolio where your drawdowns are 30%, then your overall portfolio, you're going to be in a much riskier, even though you have a 60% in your debt. So when you're assessing the risk, the same kind of a risk matrix what you applied for your debt has to be seen from the equity side as well, when you're looking this portfolio construct, and also the kind of stocks you want to add it in that.
One question that's come up is, how do you manage impact cost? Do you have certain thresholds in terms of liquidity and others to pick, given you are managing an institutional portfolio? Because in some of these small cap stocks, while the business and the story can be great, but you could also end up having material impact cost if you want to action it on a specific idea.
Yes, that's a more valid and pertinent question, Shri. When you are looking on this time, that's where the time frame comes into play. Because when you are buying the stock, the impact cost also is going to be high. And you would also need to see whether your risk reward ratio, what you are going to bet on, is makes sense that you can take on that 10-15% impact cost in accumulating that stock, right? And similarly, you are going to see that when you are selling also, you should going to see that same impact cost. But what has happened is that illiquid profile will change over the period. So when you are accumulating that time, maybe the stock may be trading at say 20,000 shares in a day or 50,000 shares in a day. But in over a 3 to 4 years time frame, when the institutions start discovering the stock and the more institutional participation and the more sophisticated investors start participating in the company, automatically the liquidity starts building in. So we don't look the liquidity on the exit time, because we know that it's a 3 to 4 years we will the liquidity will come back. But when the impact cost we look is more from when we are investing on this thing. So up to a 20-25% kind of impact cost over the period of when you are building your portfolio, we are fine with it, because we are looking for your edge and odds when you put the thing, when you are looking something which is much triple digit kind of on a return, then in that case you are okay to take that impact cost.
That's extremely helpful. Couple of questions more forward looking, and I'll leave it to you if you want to answer it. On a next 5 to 10 year basis, any specific sectors you think looks very, very interesting from an India perspective, or would you continue to consider investing only in the same set of 3-4 sectors that you would highlighted? And second is on what else? What's your outlook for Indian equity markets more at a more broader level than
sure. See, on the sectoral things, yes, we will be looking for the newer sectors and the new business models which are emerging, which we will be continuously evaluating. See, it's not that when we said that we focus on 4 or 5 sector, we are also continuously will be evaluating on the new businesses and new industry which is coming in. And one of the things which we saw in the last 5-6 years is the temp staffing businesses, right? The services business which is a new businesses. So we started looking this thing. We also participated in that business because that's then we also has the exchanges businesses, which has been now becoming, because these all monopolistic businesses where the winner takes all market. That's the kind of a businesses which we have been looking on this thing. Because if you look at the winners take all market, which is not just only in the .com space, it's happening even in the brick and mortar businesses as well. There are businesses which is holding at 85-90% of the market share in very niche chemical areas or a niche pharmaceuticals areas and everything. So we will be continuously looking for the businesses. But once again, go back to our fundamental things is that same ROC and ROE and no leverage, and looking for the businesses which there is a margin expansion and an ROE expansion happening. So that's the basic fundamental foundations when you are applying to any new businesses on this thing. So it's more than a top-down coming. It's more of a bottom-up approach with this things which is we are putting in. Coming back to on the India, yes, we are continue to see bullish on India. I think this growth is what we are seeing is going to be a multi-year and a multi-decade growth. There is a lot of changes which is happening at the ground level, both macro as well as structural changes which has been happened in the last 5-6 years. I think we will be seeing the new markets hitting the new highs in the coming years. So there's no way. Yes, in intermediate we see some corrections, maybe a 10%, 15% correction, because we have been seeing that markets have been also gone up, and it needs to be cool off and get consolidated before going to a next level. I think equity in India we can easily see a double-digit CAGRing for the next 10 years.
That's extremely helpful and optimistic. Just want to kind of, before we wind down, start off with close it or the one big question. You looked at privates, you looked at publics. What are the 2 to 3 things you look for when you meet an entrepreneur or professional CEO that gets you excited about a particular person or says, I won't invest in this company at all? What are those 2, 3 things that gets you going, or just hate? Hate may be a too strong a word, but will not make you invest in those companies.
First and foremost, in any business, we can talk about it. Within the same industry, you may have one star performance, and then there are a bunch of the lemons also is there in the each sector. The first and foremost is finding an investor is the most important than anything else in the business model. You may see a good business model and then strong ROE, but if you see in a promoters and is past they manage the company, their employees, their whole stakeholders, the treating of the stakeholders, the return which has been given by the promoters, their disclosure norms, their transparency. These things makes a lot of the sense for us. That's the first and foremost hygiene criteria when we are looking in our thing. We have a big checklist on this, and the maximum checklist in our thing is more than the quantitative parameters. It's a more of a qualitative in nature about the promoter, their team, their disclosures in their annual reports, the corporate governance level, the board directors, how many family members, non-family members, so all these things is the thing is more important because within the sector because when you're looking at concentrated bet within the sector, you are not going to take more than 3 or 4 companies, right? And so that means when you're rating that company, you have to see that you are investing in the promoter who have been an investor who have been proven whatever he said previously he has been delivered, and he is also not doing something for the shortcut for just for the market. That's the most thing which we've been looking. And another thing is an honest thing is when even if they made mistake and honestly coming to the market and saying that yes, we goofed up or we made mistake. So that's the one thing which we are doing is more of a the disclosures and the corporate governance level what they carry on.
With that, I think so we are on the dot at 7:15. Thanks a lot for this extremely insightful session, Hari. I especially love the iCube thought process, and you continue to help us think better and hopefully make better, as good a portfolio manager as you are. Thanks a lot, Hari. Have a good evening and a great weekend. Thanks a lot, ladies and gentlemen, for your participation.
Thank you.
And for the Chennai chapter people, there's a networking session that will start maybe another 5 minutes. Do reach out to Meera, Vijay, or any of us if you don't have the link. There's a separate Zoom link on the meeting IDs that's been shared. Thank you.
Thank you so much, Hari. Thank you so much, Srivathsan. Everyone, this networking session is open to the entire, to all the attendees. I have already shared the Zoom link. We are starting the networking session in the next couple of seconds. Do join in, everybody. Thank you.
Thanks.
Thanks, Shraddha. Bye.
Thank you. Bye.